Okay, now we are recording. And yeah, so the answer to this question is you should trade strategies that are not correlated, because then it will be like you're trading double the number of contracts for the same strategy. So imagine if your strategy is correlated, doesn't matter what symbol, once you test correlation, and if it's high, that's it. It's just like adding more risk to the same trade. And so the best way to go about it, well, first let's make it clear that yes, we do need to trade a portfolio. That's a given, yes. So I would say minimum 5 strategies would really add a huge benefit to diversification. And how would you go about that is, for example, you mentioned $25,000. So definitely that's not going to do it for the E-mini contracts. So then you would go to micro contracts. And I'm assuming futures. But currencies, stocks, definitely 25 will work. In either case, you want to be able to trade, to take those multiple trades. So if you picked, let's say, 5 strategies, you have to test, what's their signal like? So do they trade like, once a week, once a month? What's the overlapping of their signals? And again, that's also through testing. Once you do that, then you can find, throughout the test, let's say, I don't know, maximum you trade it twice simultaneously. So then you can divide your capital that way. Of course, the only way I would do it is through Monte Carlo. So like the last video I did, that's how I do it. I bring all the strategies together. I say, look, I have $25,000. Would I be able to trade this? Yes or no? And then I keep mixing and matching. Like, you cannot force. You should come at this from the other side. Like, don't go from this side. Don't go, I have $25,000. Let's see what fits. Mix a portfolio and then see how much money that portfolio needs. And go from that side. That's how I would do it. Like, I see many people fall into this trap, or I want to make $2,000 a month, or I want to make, it should be the other way around, because you cannot force the market to give you anything. It's not like, it's obeying some laws. There are no laws that the market will give you 10% or minus 20%. So you should go with your strategies. The easiest way I would do is, obviously, Forex and stocks can be easily scaled. Well, at these figures, not all stocks. But let's say most of the stocks can be easily scaled. Like, you cannot scale, let's say, Amazon and Berkshire Hathaway. They are too expensive. But if you exclude, let's say the top 10, 15 stocks out, you can easily scale stocks. And also today we have fractional shares. So let's say stocks can be easily scaled. Forex definitely can be easily scaled. And also micro futures to a point, like $25,000 should be doable to trade 3-5 strategies. But it all comes back to testing. You need to test. So mix the strategies in a portfolio, first of all, to achieve diversification. So they don't overlap, they don't have high correlation. And then go in Monte Carlo and see how much capital that portfolio needs to achieve your goals. Again, because remember, this is not set in stone. So you might be able to start with 25,000, but then your confidence for a low drawdown, let's say, shoots to 50%. So I would again recommend, really, last video I did, this is exactly what you need to do to figure out how much money to trade. Okay, and what would be your advice about trading futures regarding position sizing? If you have 100K, you were talking about future basic leverage. Okay, so I think I saw also another comment about leverage, which I think was interpreted the wrong way. So I said, futures already leveraged. You don't have to do anything. In fact, if anything, you're reducing leverage. How? By this. When you do this, you are reducing the leverage of your future contract. Because obviously 100K can trade, let's say 9 contracts or 10 contracts, let's say, of ES, but you're not going to do that because through this method, you're probably going to be able to trade either one contract or no contract. So you're reducing the leverage. So the futures are good because they give us the option to increase leverage. But of course, we're always on the other side. With I said with currencies, I would only go maximum 40 or 50 because the volatility of the currency is totally different than the volatility of, let's say, crude oil. So going back to this example, if I do this ATR thing on currencies, you would find, let's say you need to trade, I don't know, 5 lots to achieve a loss of $1,000. So 5 lots is $500,000. That's why you need bigger leverage, not because it's Forex. It's because the movement will not produce the pips movement, 1 ATR a day, will not give me a swing of $1,000 if I trade with a leverage of 1-to-1 or 2-to-1. Okay? That's also the same thing for futures, for interest rate futures. So interest rate futures, they have low volatility. So therefore, if you have, let's say, interest rate strategy here and crude oil, you will find you're trading roughly 5 times the number of contracts in interest rates than in crude to achieve the same risk. And that's the same thing for currencies. So it's not a figure that I pull randomly. It's based on volatility. And so that's number one. Number two, you were talking about futures basic leverage. If you move 100K, it's possible. Yes, of course, you will control more money with the same amount because you're getting leverage. But 2%, so this is what it's, so this is linked, and this is the idea. Forget about how much money you're controlling. Even if your 100K is controlling $10 million, it doesn't matter. You're only worried about the loss contributions from each strategy, and you want to make that loss equal across the portfolio. So if you decided you will accept 2% risk per trade, and again, why 2%, why not 5%, or why not 0.25%? It all goes back to the drawdown. Again, if you see my last video in the Monte Carlo, I can set my goal. So through Monte Carlo testing, I will set my goal. Look, I want 98% of my future curves to have, let's say, 10% drawdown. In that case, maybe 2% is too much, which I can tell you it is. So for managing clients' money, probably 0.25% is the correct method. Because with 0.25, you will achieve most of the, I mean, this is not fixed, but most of the time you will get less than 10% drawdown, which is that the set goal for all people who are managing money. But for you, for your portfolio, of course, you can set it anything. And that's why on purpose I set mine on the video to 35. Because it's your money, you should be able to do whatever you like with it. And I accept 35 because I want more returns. And from that number, from that drawdown number, then you can decide, okay, how much risk you can take per trade. In this case, let's say 2%. And then you do that whole equation. Okay, robustness testing for random genetic strategies, for me, opposite to what you talked. Okay, so this question, I do a lot of strategies on purpose on the channel, at least. That doesn't mean I don't do random strategies. It's not a good content on the channel, because what, we're gonna sit and look at the computer producing strategies? It's not like exciting content. It might be, I mean, for you, but it's not for everybody. So yes, definitely the robustness methodology has nothing to do with how you created your strategy. So I might be creating it on purpose or through randomness. At the end, the concept is the same. The principle is the same. There are like a few principles that work across the board, which is you want, let's say 70% of them profitable. You don't want one run contributing more than 50% of the profits to the whole runs. Like, there are some fixed principles regardless of how you're doing your robustness. So yeah, definitely the robustness workflow applies to all the ways that you develop your strategy. Liquidity is, of course, different across all instruments. So most exchange traded instruments, they have, for example, here in the US, like, you have Eastern Standard Time. That's the most liquid time you can trade stocks, futures. Forex have some like window in Europe that is liquid, another window in Asia that is liquid, and of course another window in New York that is liquid. For crypto, it's totally different depending on the coin and the exchange it's traded on. But you will get this Excel sheet, and this shows you the liquidity. So for example, this is crude oil, I think. Yes, this is crude oil. And you can see, so 10 to 12 is the most active, followed by 1 to 3. This is Eastern Standard Time. And then you will go from 4 to 9, and then the rest, which is the blue, which is the least active. So you can plan that way. Like, you cannot just pick time. You need to see what's the most active time. And so, for example, here you can see this hour, which is Wednesday at 11 a.m. It's the most active time, because we have news every Wednesday. And so this is the way to find out the most active time. Tick data, I don't know if this is related, but if you're asking about using tick data, it's not worth the resources you're gonna need to test the tick data. So obviously tick data is available, you can buy it. So unless you're doing high frequency trading, it will not add, I mean, it's definitely high resolution, but it will not add a lot to you, considering how much resources you're gonna devote to get tick data. So I wouldn't use that. So Fibonacci is not included in SQX, and then you can, that's one. External data you can get into MT45. You can get external data in all platforms. Unfortunately, I don't use MT45. I know you can get data into it, but how to get the external data, I don't know. You can buy definitely data, external data source, and you can hook it up with MT4. You'll have to look at how to do that, but I am positive 100% that you can do it. All trading platforms have a way to connect to data providers or manual data. So for example, you have a text document that you have all the data inside it, and then you can connect that too. So definitely all of them have this possibility, except I don't know how to do it in MT4. For example, in TradeStation, you just import the data, or you might have a different connection. For example, in MultiCharts, you can switch data providers. So let's say you have 2 subscriptions, one for CFD data provider and the other one for let's say, Forex provider. Let's say you have two. You can, during your session, you can switch the data provider. So it's definitely doable. Yes, so the way Edge performs, so Edge starts somewhere at the peak and then drops all the way down. And this could be 1 day or could be 1 month, depending on your strategy. The way Edge is calculated, because Clonex did this indicator in SQX, and he did not do this. So that's why I do not use it today, because I don't know how, like, what the figure is he is getting. Is it day 1 or is it day 10 or is it day 2? I don't know how he's calculating. So, which you faced it here already, because you can see that H1 produced different one, and day 1 produced different one, and week 1 produced different one. So I don't know where it sits. So his calculation, I don't know where it sits. So I don't use it, because probably implement a different thing. But edge ratio, it changes over time. Like if you go and look at the calculation of edge, it uses maximum adverse excursion. And of course, this MAE changes over time. And so definitely this curve should change over time. So I would assume most likely that he is taking MAE figure that is fixed. And so most likely it is the initial stage of the trade. So that means you put the trade on, what's the MAE for this trade at that point, and that's the edge ratio it's calculated. So it doesn't apply. So my theory here does not apply to SQX, because SQX did not implement that in yet. I asked him many times. He said structurally it's not doable yet, but he's looking to do it. So until then, I'm not using it that way, because the way you use this is you can see. So for example, let's say because edge has to be more than 1, and so let's say this comes down to 3 days. So you enter the trade. After 3 days, your edge goes below 1. And most likely you will find, if you add exit after 3 days, so regardless of your logic has entry, RSI, moving average, and then stop loss, profit target, whatever it is. Then you can add this condition, exit after 3 days, and it should benefit the strategy, because your edge drops on average after 3 days. It drops below 1. So it could be 3 or 4 days here, and you'll find this exit is good. So that's how we use edge ratio. That is not the implementation in SQX, so we cannot do this there. And finally, I want to get into this because I got also a couple more questions on it. Multiple strategies on the same symbol. So we need to understand that to trade multiple strategies on same symbol, meaning long and short, or even one direction, doesn't matter. Why this is difficult? And some people I saw mentioning MT4, and some people, it looks like I thought they understand why, but it looks like nobody's getting this. See, the reason has nothing to do with your platform. It's not like if I have TradeStation, you have MT4, MT4 can do this. It's all related to the broker, regardless of your trading platform. So MT4, of course, can do it, but not with every broker. Also, by the way, TradeStation can do it. But because TradeStation is used with TradeStation broker, so it cannot. But as a platform, definitely it can do it, because each platform send one single identifier for each order. So let's take an example. Say you have 5 strategies on ES. Let's say they all go long and short. The problem with executing those trades, there is something called cross-side order on the broker side. So here we can have MultiChart, we can have TradeStation, we can have MT4, we can have Think or Swim. I don't know, pick your platform. They all can do it. They all can trade multiple strategies, sending unique orders. The problem when it goes to the broker will not allow cross-side order, meaning it will not allow long-short ES or long-short same instrument, regardless of the symbol. So same symbol, the broker will not let you do 2 sides. So, okay, it's a broker thing, meaning the broker has to allow you in your account to go long and short same instrument. We established that this has nothing to do with your platform. Any platform can do this. In fact, all platforms send a unique order to distinguish it from any other order. So they all have a unique identifier. So that's not the problem. The problem is cross the broker. So how do you mitigate this? Okay, let's find solutions. There is no perfect solution, but let's try to find some solutions. So option 1 is to combine your strategies in one code and have a voting. So say you have, we mentioned here 5 strategies. So 5 strategies ES, 1 is long, 1 is short, 1 is long. You take the net. What is the net? The net is long. Okay, so you send long order. If the voting is short, you send short order. That's solution 1. Solution 2, again, you do one code for all strategies and you take the net sum of the contracts. So say you have 5 strategies, 1 went 1 long and 2 short and 2 long. So the net is 1 contract long. This is different than this because this will always trade 1 contract, either long or short. This takes the net sum of the number of contracts. That's solution 2. Solution 3, which is to separate the long and short on different 2 accounts. So you're trading here, let's say you're trading Interactive Brokers. Inside Interactive Brokers, you have 2 accounts. Account A, account 1, account 2. Then you send the longs to this account and you send the shorts to this account. Finally, there is a solution not available to everyone. It depends on your geography, your account size, your profession. But you can do a money manager account, a fund account, family office account, where you will have one account, let's call it account X. You deposit your money here. And then under account X, you have sub accounts. So sub 1, sub 2, sub 3, and so on and so forth. Okay? Then you put each strategy or each portfolio in one account. So again, you're separating the long from the shorts. The advantage here, you will use 100K. So say your portfolio is 5 strategies. You will use 100K to trade 5 strategies. The difference here you have to decide. Well, if you put 50K here and 50K here, that's it. This account has 50K only. So it's not using, so maybe this account, let's say for example, this account win 10K and this account loses 10K. So at the end, this will be 60 and this would be 40. So at some point in the future, these will not be the same. While here, if you make money or lose money, this account as a whole will always be available to all strategies. So that's the advantage. Obviously, this is the best solution. Okay, this is solution number 1. This will work with any platform. Remember, because I told you, the platform can send unique identifier to the broker. It's up to the broker to accept it or not. So this is solution number 1, is the best solution, not available to everyone. The second best, I would say, is this, to separate. And then I would go to summation. And last one, I would go to voting. And that's the way to solve trading multiple strategies on the same instrument. So you know there is a seasonality in both. So you see now natural gas is on its way down seasonally. Now I heard something that I listened to a podcast yesterday that talked about something happening in Europe. So there's a squeeze on natural gas, but seasonally natural gas should be in a downtrend now. In fact, it's a good trade, you can see, starting November 26 to 1 month to December. Yeah, Season X is really good. I've used it on many videos. I'm surprised you don't know. This is, so I think in the free version, I'm not sure, you might have only 10 years data, I think. But if you decide to use this, I have a 20% discount. You can use my coupon. It's worth it. You can build, I built 2 portfolios. Of course, the stocks portfolio is using this one. But I also have a future portfolio that it's also built on this. And they just added this, which is very close to what I am using here. This spreadsheet will be in the course. So this shows you, so this is crude oil. And it's basically more detailed, let's say, than Season X, but it also gives you this heat map, which is important. So say you want to trade crude oil. So this is crude oil, yes? So this is again the active time and the average win percent per time and average win loss in dollars. So you can build strategies using this. So I can show you here, look at this and then try it later on. So 4 a.m. on Friday all the way to 12 p.m. You can see all these are losses. 4 p.m. to 4 a.m. to 12 p.m. And if you go here, this is it. So this is 4 to 12. So that's a strategy on oil that works. I did a portfolio on oil in also some of the videos using this. I added, I think, 4 patterns, but this is really a good pattern to trade. Mosey asks, is it benefit to do SPP for exit, find best area? So SPP is not finding the best area. This is important. SPP is only telling you, if I change your exit from 3 bars to 4 bars or 2 bars or 5 bars, is your strategy still profitable? So it is not an optimization to find the best exit, but theoretically on a daily strategy, let's say, a different exit period should not affect the strategy that much. It will, depending on how. So again, let's go, let's take this example. If you are doing this strategy, I just said that right now. So this is trading 4 to 12. If you change 12 to 1 or 2, definitely it's going to affect the strategy a lot. I can see here, yes. Also, if you start before, so see here, if you start at 3, it's not that big a deal. If you start at 2, you make more money on the short side. If you start at 0, you make even more money. So it looks like Friday, starting from midnight all the way to 12, makes money. So when I change the bar back here, because it is already losing money, so on the short side it's good. But this short strategy will keep losing money if I increase the hours. So changing the exit bar here, it's not profitable. Also, it will not be robust. So you need to know what your strategy is doing in order to interpret the SPP results. If I do SPP results here, and SPP will say, well, look, I changed the exit, 1 hour, 2 hour, 3 hour, 4 hour, they're all losing money. So your strategy is not robust. That doesn't apply here because I know I'm trading a bias on Friday and it is meant to trade up to 12 p.m. So I will not take SPP results here. But if I'm trading, let's say, the close above 100-day moving average, and then you change 100-day to 90 or to 110, and then SPP says, well, it's not robust, then I believe that. Because that's not a bias. I should be able to make money if I'm crossing 100-day moving average or 90-day moving average.